This week, it's time for security money. The index is down, but not out. In the leadership and communication segment, how to build a cyber-capable board, who is legally responsible for a cyber incident, building a security culture of yes, and more. Business Security Weekly starts now.
This is Security Weekly, for security professionals, by security professionals. Broadcasting live from G-Unit Studios in Rhode Island, it's the show where we explore the business of security to improve the security of business. Your trusted source for actionable insights on leadership, communication, and innovation. Get ready for Business Security Weekly. It's time to rethink how we approach cybersecurity because the reality is modern cyber attackers are already past your initial defenses. ExtraHop helps your security team find and eradicate advanced threats before real damage is done. Protect your enterprise and customers with better defense. Learn more about how ExtraHop stops advanced threats at securityweekly.com/ExtraHop. That's extra, H-O-P. Endpoint security is designed to protect every device in your fleet, wherever it may be. These days, that can be a lot of different places. Find out how HP Wolf Security uses emerging strategies like application isolation, along with a zero-trust approach and framework to give you a powerful, manageable, usable solution to your growing and increasingly spread-out security challenges. Learn how HP Wolf Security can make a difference across your endpoints at securityweekly.com/HP Wolf.
Welcome to Business Security Weekly. This is episode number 268, recorded July 11th, 2022. I am your host, Matt Alderman. Joining me remotely are my co-hosts. First, Mr. Tyler Robinson. Welcome, Tyler.
Thanks, Matt. Glad to be here. This is an exciting episode. I'm stoked to talk this one.
Have you done a security money segment with me before?
I have not. I'm really excited.
All right, so I'll give some background because I know my second co-host has not been on a security money segment either. It's Mr. Josh Marpet. Josh, is that a new house?
Hey. Yeah, actually, this is my new garage. It's very exciting. You know, it's horribly exciting. But yeah, we moved to a new house, and I'm building out this garage as an office. So right now, it's not incredibly impressive, but it's getting there. It's getting there. The fact that I've got a desk, hey, it's a change.
Right. Desk always helps. You need some place to set all the gear, right?
Oh, God. The amount of gear I had to move.
I've been there. I've done that. Don't forget to check out our library of on-demand webcasts and technical trainings by visiting securityweekly.com/on-demand. All right. Since both of you have not done a security money segment with me, let me give a little background because it helps. When I joined Security Weekly back in 2018, I told Paul I wanted to do a segment that kind of summarized the market. And I had this concept at the time to build my own index. So I call it the Security Weekly 25 Index. It is made up of the 25 public pure play cybersecurity vendors. So what does that mean? That means Cisco is not in my index because it's not a pure play cybersecurity company, nor is IBM. They have security divisions, but I wanted to really measure more of the pure play cybersecurity vendors. So I went out and I pulled data from late 2017, and I started to build out an initial index of 25 publicly traded companies. So I've been doing this almost 4 years. And what gets interesting is that new companies go public and existing companies go private. So every once in a while, I have to swap out one or two companies in the index because they're no longer traded. Most of them are traded on the Nasdaq. There's a few that are overseas. So that's how it started. It was this concept of how would I track the market? Let's look at the security players that are public, track them, 4 years of data, and I compare them to the Nasdaq. So I actually track the Nasdaq during the exact same period. So I know the performance of this index, for example, over the Nasdaq index. All right, so I'm going to stop there in case you guys have questions.
No, I think that's super useful. I mean, the one question I did have was, is there correlation to the Nasdaq, how the Nasdaq's doing, and the direct correlation to, say, your pure security play versus what the Nasdaq's doing in relation?
Yeah, in the show notes, Tyler, I actually published 2 graphs. So you'll see a graph of the index, and you'll see a graph of the index overlaid with the Nasdaq. So what you're going to see, very similar up and down trends. The Nasdaq, because it's a broad-based technology, and we are part of that technology structure, we tend to track it very closely. Not exactly. But when the Nasdaq drops, the index drops. When the Nasdaq gains, the index gains. The percentages are different, but they track very closely.
I'd be really curious to see this against the S&P 500 because the S&P is not security/technology focused, and I'd be curious to see how it differs just in trends. You know what I'm saying? So a graph against the S&P 500 against the Dow, that's the DJIA, to see how the technology world is faring as compared to the business world, if you will.
Yeah, it's actually very easy to add because it's a simple. I use Google Finance formula, populates all this data, and so I just add the ticker symbol. It'll throw it in. I could create a chart pretty easily, Josh. So I'll do that. I'll share it with you guys, and I'll go out and update the show notes later just to see how it does. But it's actually a pretty easy add because all the dates are going to align with all the other data, so it would be interesting.
Yeah, it should be a 5-minute ad, but I tell you, seeing that and then against what is it, Hack, Cyber, and QQQ, some of the other indexes, would be fascinating.
Yeah. All good comparisons, all pretty easy to add. The sticker stock symbol.
This is nice.
So the thing that gets really complicated is when I have to make a swap. So, for example, Mimecast just went public. They stopped trading on the public market on May 18th of 2022. So in order to calculate the index to Friday, because it's actually through Friday's date, I had to update the index. Now, here's where most of the work comes for me. When a stock comes off the index, I can't use my formula anymore. So I have to go pull all the historical data and all their stock price closes and refill that in my spreadsheet. And then I have to create a break in the historical data because now I'm adding a new stock symbol. So in this particular case, I added Sentinel-1 to the index. Why Sentinel-1? Typically what I do is when I make a change to the index, I look for which company's coming out and I look at their market cap and I try to find one very similar to that market cap to come back into the index. The reason I do that is it keeps the index somewhat balanced the way it was set up before. So Mimecast was like 4.8 million or 4.8 billion in market cap when it came off. Sentinel-1 was right around 5 billion, something like that. So that's the replacement I did. But what I have to do is I have to update the divisor. It is a weighted index. So the Nasdaq is a weighted index. What does that mean? It means that each of the stocks in there have a specific weighting to them that is used to calculate the index. The Dow Jones Industrial Average is not a weighted index for those playing at home. The way that's calculated is a little different than the Nasdaq and the S&P 500, which are weighted indexes. So when I replace a stock, I have to recalculate the weights for each of the individual stocks. That's why I want to find a very similar market cap because it keeps the weightings very close to what they were on the previous run. And then from May 19th down, I update all the data points.
Okay, so when you pick a new stock for this Security Weekly 25, are you looking for one that you think is going to be a successful company, or are you looking for? I mean, the market cap, I get it; it makes sense. You take a company that's this big, you replace it with a company that's about the same size. I get it. But are you also looking for? Okay, I think Sentinel-1 is going to go amazingly well. I think they're going to do the same as Mimecast. What's your criteria? I'm honestly curious.
So my original criteria was the company had to have $1 billion market cap or more. Now, that's when I did the original index. And so I still try to stay to that. So I'll give you some examples where that wasn't the case. Tufin came out public a couple years ago. Their market cap was 600 million. They didn't hit the threshold.
Right.
We'll talk about Tufin because they just got acquired by a private equity firm, so they're coming off the public market. So we'll hold that thought for a second. SecureWorks was $1 billion. Now they're currently they're right around 900 million right now. So they were at the threshold, Josh, but fell below it. But I haven't pulled them off the index because they've been there since the start, right? So I also look at who. Well, I have to go through and look at who's doing IPOs. Because the IPO, we had Darktrace go, we had KnowBe4 go, who's on the index, we had Sentinel-1 go, but I didn't add Sentinel-1 when I added KnowBe4 because when I did the KnowBe4 ad, it was because the market cap was very similar to the one that I pulled off, right? So I don't have a ton to pick from when you think about it. It's all based on where the markets are, who meets the $1 billion threshold, and who's available. Because what's happening is a lot of firms are getting pulled off the market. SailPoint's going to come off. SailPoint's getting acquired by Thoma Bravo. At some point, the SailPoint stock that is in my index will have to be replaced by another one because it will come off the market.
This is interesting. I'm sorry. This raises such incredibly cool questions. Like, do you see the market moving more towards a private ownership, private equity and private firms, or do you see it moving more towards public? Do you see it just as a churn situation? There's what do you see in terms of success of public versus private? There's so many questions that this raises. It's so fun.
So I can answer some of those, but let me give some basic information first. Okay.
I'm sorry. Go ahead, please.
No, it's fine, Josh. This is why I wanted you on the segment because I knew you'd ask some great questions. So the first thing, as of close on Friday, which was July 7th, 8th, no, 10, yeah, 8th, July 8th. The index closed at 2,015.46. When I created the original index, I created the index at 1,000. Okay, so it's up 101.55% since inception. It's been a lot higher, Josh. I mean, the highest it's ever been was over 3,000. Okay, so it's down, but it's still outperforming. 4 years later, it's at 101% of the original index setting at 1,000. Now, compare that to the Nasdaq. The Nasdaq closed at 11,635.31 on Friday. That's an increase of 75.63%. During the same period. So I think, Tyler, you asked the question. The index currently is outperforming the Nasdaq over the exact same period by about 26 points.
Jeez.
So why aren't our listeners crowdsourcing the index? Come on, get some investment.
I have published the Security Weekly 25 Index on previous shows. It's not in my show notes. If anybody wants to know the 25 companies, I can add them to the show notes, or you guys can send me a note or whatever. I have it. It's in a big spreadsheet. So it's an interesting list of companies. But if anybody wanted to crowdsource it, I guess they could. Anyways, I don't have an official registration, so I can't actively trade it, but it would actually be kind of fun.
But if you do really well, he does have a Venmo account, so.
Actually, I don't. I'm old school. I use Zelle and PayPal. I know. I'm old.
Cash,
baby. Cash always works. All right. Now, the other thing is, I haven't done this segment in 2 quarters. So the results here are for 2 quarters worth. We were so busy in April with sponsored and interview segments and CISO segments that we didn't do it. Normally, I would have done this in April. So this is 6 months worth of data. So I pulled the Q1 earnings statements. So what you do is in Q2, you report against your previous earnings for Q1. So I always run these numbers, Josh and Tyler, because I want to see how the stocks are performing against analyst expectations, because that's always another interesting data point for me. So revenue beat by 2.72% on average. So from a revenue perspective, the companies were pretty in line with expectations. And this has always been around 2 to 3%, right? It's exactly the same as I did it 6 months ago. 2.72% on average revenue beat.
Is that pretty standard for security companies, though, where budgets are probably typically outlined at the beginning of the year during their budgetary hearings and however they're doing it? But you'd see a big shift in something like this with markets going down in the next budget year if you're going to see a big revenue decrease, correct?
Correct. There are some misses in for certain companies, and I'll talk about that in a second, because most of the security dollars are subscription recurring revenue dollars, this number stays pretty consistent actually. Because most security vendors, because they're in an ARR model and they're just doing a lot of the cash is deferred revenue, this number stays in that kind of 2 to 3% kind of average. Yeah, every once in a while you're going to see somebody miss a revenue number by a bit or not, but this has been pretty consistent. The one that is more fluctuating is earnings. Earnings are the one area where you get huge variations in performance. Okay, so earnings beat by 3,650% on average in Q1 of 2022. Okay,
wow.
Now, yeah, it's a crazy number, and here's why the number is crazy, because it's an absolute number. Most of the index was negative earnings for the quarter. I was actually amazed. Yeah. So I was actually pretty amazed at how many of the companies that were profitable have dipped back into negative earnings in Q1 2022. Now that's a tell sign for me, because you asked about some of this. Does that mean things are better or worse? Well, that means revenue to costs have shifted in the last 6 months. Now that shouldn't be surprising to anybody that's watched the market lately, right? There are companies that are out looking to trim costs. So margins are where in earnings are where things get really, really interesting. Because a lot of the margins are negative, a little beat on a negative margin actually kind of has a huge impact. So that's why the average is so high. But on a case-by-case basis, I mean, I think outside of one or two stocks, they were pretty much in line.
So you're going to start seeing a lot more fluctuation there with some of the inflation happening, a lot of the recession indicator markets. You start to see things that cascade effect with housing markets and interest rates when the Feds start playing with stuff. So I think a lot of these numbers are like interesting, Q1, Q2. I think the next two quarters are going to be the ones that really start to put some indicators around the tech. The tech companies are interesting, though. You see a lot of the companies buckle down, start doing lower spending, and really get tight on their budgets. But with all of the regulatory bodies and all the things that are required for many of these technology companies, like you said, a lot of the subscription models have to maintain their performance because those are required in most companies. So how does the tech industry actually differ from a lot of the other indexes and markets that are playing out?
Yeah. You tend to see higher interest rates affect the tech market more because of need for capital in the tech markets. That's why the Nasdaq took such a big hit with some of the inflation changes. And that's trickling through the security market as well, Tyler, for sure.
You'll see a lot of that with
cheap money.
Go ahead.
Cheap money
was great for everybody. Yeah.
Yeah, that's what I was going to say. A lot of the VCs and stuff are going to be buckling down on how much they're actually looking to acquire companies for. So really bad if you're trying to go IPO or you're trying to go public, but really good for the VCs that are spending the money. You're going to have a lot more purchases at a lot lower cost.
Yeah, I've been hearing that valuations out in the California area are coming down significantly. I've been hearing that acquisitions, investments are a lot easier to do for the investors. For the companies, you better have traction or you're in trouble. But of course, that's at a very different scale than the public companies that you're talking about in the Security Weekly 25. And I think it's fascinating that the investables are almost a leading indicator or a current indicator with inflation and money hardness, whether money's hard to get or easy to get, but that public companies are probably going to be a lagging indicator. In other words, their issues are going to come 3 months, 6 months, 9 months after this kind of inflation happens. I mean, because look, most of these companies are doing subscription-based or long-term contracts or a combination of both. How often do they want to raise prices or touch anything that procurement has okayed a year ago, 2 years ago, 3 years ago?
Yeah, you're right, Josh. That's why the revenue numbers are pretty consistent quarter to quarter to quarter for exactly that reason. It's the cost side that really affects earnings at the end of the day, and acquisitions and some other things. So a couple more numbers, some highlights, and then I want to talk about the private side because I also track all the private investment as well. So I also look at the analyst ratings, and the analyst ratings on average was 1.709. It's a stronger buy signal. It's a little down from when I did this 6 months ago. Not major though. Best rated by the analysts are Palo Alto, Tenable, which was on the list since 6 months ago, and CrowdStrike. So the analysts rate those three companies the best. They rate SecureWorks again, NetScout, and Mandiant again as the worst rated. Now, somebody asked a question about why Mandiant. Mandiant's an interesting company, right? They sold the product side off from FireEye.
Right.
Mandiant's one of the best IR firms out there, but it has a lot of people in the mix, right? So when you think about it from a growth perspective, this is why I think SecureWorks gets a ding, by the way, is services doesn't get the same valuation as a pure product company, right? And so Mandiant and SecureWorks that have a lot of services in the business typically are not viewed by the financial analysts in a positive light. That's why they're usually rated lower.
It's interesting because people are the most expensive piece, and it's hard to scale, and you can't do, you don't make money while you sleep with a services company was the line I was always told, right? And so it's difficult, whereas a pure play product company is like, we just keep selling whether we're awake or asleep. We make money no matter what. And we can scale because we can just sell more copies of it. It doesn't cost us anything.
Right.
It's interesting that like SecureWorks, which you think is a product company, and it's not. It is a people company. It is a services company. They're SOC. They're all of the different things that they do to manage, monitor, and maintain those products, and to manage and secure their customers.
SecureWorks is actually both. They've really built out a platform that they license to smaller MSSPs. They actually have a pretty broad-based platform that they license. They've traditionally been very services-oriented. Yeah, I have a really good friend over there. I spent some time at RSA back a couple months ago. But they are building out a platform that they can license. So they are shifting from a pure service play, which was their primary model, right, to a more of a be able to build out a platform, license that platform, and still offer services. So they are trying to balance the revenue, for sure.
I see the same thing for Mandiant happening. Either that or Google's going to like disappear them into the alphabet soup letter and do nothing with it. But with the Simplify and Istio and Mandiant acquisitions by Google in Q1, I see that all turning into some sort of a platform. It's that or, like I said, a grave.
Yeah, well, we'll talk about that in a few minutes because it is interesting. They made 3 major acquisitions. I think they're going to bring this stuff together with Chronicle. It's going to be really interesting to see how Google puts all these pieces together, including the Mandiant IR capabilities. Because when you really think about it, what the SOC needs to do is identify where the issue is, but ultimately you got to go send somebody to fix it, right? And so Mandiant's great at that, but how does that all fit into this whole Google security play? It would be interesting to see how it plays out. Anyways,
that's the smartest thing they could have done with Kaseya buying Datto. I mean, the drama around that is monstrous. I didn't even look if that was in the articles. I apologize, but I mean, I've been following the Kaseya Datto drama, and that's going to sink a lot of companies, a lot of MSPs, a lot of MSSPs, and Google with Mandiant and all the security tools that they have, they could legitimately pick up so much work and just go crazy.
Yeah, for sure.
This is fascinating.
Couple quick items. So there was one IPO. Hub Security did go IPO via a SPAC. I did not pull all the numbers for it. It did go public via SPAC. I think it was late Q1. Mergers and acquisitions in Q2, SailPoint by Thoma Bravo, which means SailPoint's coming off my index probably the next time I do it because they're going private. They're going to the broader Thoma Bravo portfolio. As you guys know, Thoma Bravo's purchased a lot of companies over the last few years and taken them private. So they've got a pretty broad portfolio. VMware was also acquired by Broadcom. That was a $61 billion acquisition. Now, Broadcom's done some interesting stuff with CA, Symantec, and now VMware. They've spun certain pieces off, so it'll be interesting. VMware is not in my index because, again, they're not a pure play, but they have a lot of security products in the portfolio. They've got Carbon Black. They've got some other products in the portfolio that are security related. It'll be interesting to see what Broadcom does with those pieces because they've spun those out from CA and from Symantec. So it is very possible we see Carbon Black spin back out as a separate company, maybe. Just saying. I've seen it happen before.
I would love to see them do something with this because a couple of these acquisitions are super interesting. The VMware is fascinating. Like, why, for one? For two, like, hopefully it is not just a money play and they're just moving stuff, because that could be very interesting and they could bolt together, just like Google has the ability to bolt together some of these things and make really good products and or services together. Like, I see that one as one of the bigger plays if they leveraged it properly. It could do a lot.
Yeah.
If they leverage it properly, it could be huge. Fortunately or unfortunately, VMware has so many moving pieces. Like, there's so many different products and services that VMware has. It's ridiculous. They could spin off a dozen things and not even hit the main sort of body of it.
They're almost like Amazon or Microsoft in that respect.
Yeah. Well, that's why I think the VMware acquisition is actually interesting when you think about it, because they're probably going after the virtualization components, not necessarily the security components, which is why I say we may see Carbon Black spin out as a separate company again.
Maybe. Yeah. Or some
Perva. It happened with parts of the Symantec portfolio. I mean, come on. Yeah. A couple other just highlights. Citrix Systems went private. I already talked about MindPaths going private. There were 2 filings for IPO. Optiv filed but decided to hold, and Cybereason confidentially filed but also held. The market is not ready for an IPO right now. So both Optiv and Cybereason filed. They wanted to go. The market's tanked. Those IPOs are on hold indefinitely until we see what's going to happen. My guess is you got to, this is a 12 to 18 month window, I think, for most organizations to get through, which includes the IPO market. I don't know that we see another IPO for another 12 to 18 months. So it'll be interesting to see what happens with Optiv and Cybereason in the near term, because it looks like that path to exit is currently closed.
What does the going on hold have any negative connotations to them other than the fact that, the market's tanked and they've kind of held out from a logistical standpoint?
Optiv, this is the second time Optiv has done this, by the way. So, Optiv had filed back in 2016, I think, to go public, and then KKR came in and picked them up. I think the challenge with Optiv, I worked at Accuvant. I knew the original founders extremely well. The challenge with that business is they're a reseller. Lots of revenue, $5-6 billion in revenue, but not a lot of profitability. That is not necessarily an optimal configuration to go into the public market. So they've been sold a couple times via private equity firms. I think KKR wanted to see an exit here and get out, put them on the, go through the IPO route, but that market's closed. So it's very possible we see Optiv go to another private equity firm. We could see another turnover of Optiv. I think that's the likely candidate. Cybereason's a little less known to me because there's been great IPOs with Carbon Black, with CrowdStrike, with SentinelOne. I think Cybereason is another endpoint solution, wanted to get into the public market. But again, you saw the big announcement right around RSA with the big layoff at Cybereason. That's to cut costs, extend the burn rate, or shorten the, conserve cash, make that
keep the runway open.
Yeah, get that runway extended and maybe squeak in an IPO in 12 months if the market's open back up. But otherwise, you're going to have to go raise some more funds, is my guess.
I'm going to say that.
How many rounds have they done?
Extension.
Anybody know how many rounds they've actually done in fundraising?
No, not off the top of my head, but they're probably into at least D round.
Oh, wow. Yeah, I would be curious to see what that runway, the burn rate and the runway, based on the layoffs that they've done to kind of calculate what they're estimating they're maybe looking for an IPO at.
Yeah, be interesting.
They've raised $750 million. They're oh dear God, no, try Series F, like Frank.
Okay. Yeah. D, E, F, 4, 5, 6. Tanium's another one,
Wow.
taking a lot of money. They haven't done anything yet. So I mean, there's a lot of companies kind of like stuck right this second because they can't go. The other thing I track is all the private companies. So you guys will see a list of all the private companies. I'm not going to go through all of them. Here's what I noticed between Q1 and Q2. Number of deals is roughly the same. Deal sizes in Q2 have come down. You had some really big deals in Q1. Securonics was $1 billion. 1Password was $620 million. eCentire was $325 million. Devo was $250. Blue Voyant was $250. Axonius was $200 million. That's a lot of money in a handful of deals, right? When you go down to Q2, they drop down. Sonar Source at 412 is the highest, and then you have two, Abnormal Security and Pathlock at 200 million each. Those are the highest, right? So the size of the investments have come way down in Q2, and that's just because of what we talked to Alberto Yepes 2 weeks ago on the show about was, the markets are going. There's headwinds, and the next 12 to 18 months are going to be tough, and you're going to see very compressed valuations, both for fundraising and acquisitions, but there are still going to be exit points because there are companies that have cash that can make investments. I won't say the company's name, but I met with the CEO at RSA, and I said, "How's it going?" He says, "My stock's over $100 and I have $400 million in the bank. I'm good." Because as valuations come down, he can put that cash to use to make strategic acquisitions at probably about a 3x less valuation point right now. I mean, that's what it is. Yeah, it went from a 150x multiplier down to about a 50x multiplier right now. Josh, just so you know, because I've talked to a number in this industry. So you can buy something for a third of what you would have bought it for in Q1. So you can take that cash and use it to make very strategic acquisitions.
Bad for companies, really good for VCs right now.
Yeah.
And public companies that have cash.
Yep. I also think that drives some innovation, though. That forces companies to actually get the valuation to the proper point. It puts them in a better strategic marketplace for success. I think a lot of these VCs are setting up companies for failure when they're giving them such large valuations and then having that continual funding and hopefully exit strategy that may be overvalued anyway and is never going to perform to what the investors needed. So I think it's a good market shift that needed to happen. Kind of sucks it happened on the tailwind of a inflation and a recession, but that's how it goes.
That's when they happen, though, dude. I mean, that's when that kind of thing does happen. But I mean, honestly, we had some significant overvaluations in a lot of places, and I'm not saying all of them. There were some companies that sold for very legitimate money that did very legitimate work, but you're also having a problem with when everybody is selling for gazillions of dollars. You get a lot of copycats that are selling for way too much. This is going to help wean or lean down the market. And it's going to help, as you said, Tyler, it's going to help bring out innovation because people are going to be like, I need to stand out. I don't just need a decent product. I need a killer product with good traction, with actual customers that are giving me this magic thing called money. So I have revenue, and then you'll see a reasonable price for your company.
Yes. Yeah. Expectations are going to get realigned very quickly.
Well said.
Yeah. A few interesting acquisitions. We talked about the Google acquisitions. They did 3 acquisitions, Simplify, Actifio, and Mandiant, all in Q1. It'll be interesting to see how this plays out. Schwartz Group, they're an EU retail giant. They buy XM Cyber, which is a deception company. That's like the oddest acquisition I've ever seen. Like, what is a retail giant going to do with XM Cyber? We'll see, but it just one of those that kind of pops out like, whoa, where did that come from? Fusion Center, which is an MSSP, is acquired by Morgan Stanley. Morgan Stanley is going to get in the MSSP game, or are they going to use it internally? Well, like,
did they need a SOC? What are they doing?
I don't know. Just interesting, right?
Did they just want to in-house the capability?
Maybe.
Booz Allen one's another interesting one. Yes.
Yeah, the Everwatch by Booz Allen Hamilton. Because again, they're going to. I think they're beefing up their capabilities in the federal space. I think is why this acquisition happened, Tyler.
Yeah, and they sold off or spun out Snap Attack, so that probably left them a little bit of money that they needed to do something with, as well as maybe a small gap in capability.
Yep. Barracuda gets acquired by another private equity firm. This one, KKR. I think Thoma Bravo took them out of the public market originally, and now KKR is buying them from Thoma Bravo. So you see these private equity deals in here. Tufin was in the public market. They get bought out by Turn River Capital for $570 million. Remember, I told you original valuation for Tufin in the public market was about $600 million. It's pretty much a wash in my eyes. Yeah.
What about Behavio? Do you know anything about BehavioSec?
Well, so this is the LexisNexis Risk Management Group, and I think they're looking at using some of this in some of the fraud and risk management products within the LexisNexis line. Okay. That's where I think BehavioSec had some capabilities. That's my guess, is they're going to use it for fraud, I think.
No, that makes sense. I was trying to figure out what LexisNexis was going to do with a behavioral analytics company.
Yeah, exactly right. So a lot of traction in the last 6 months. Like I said, the index is down, but it's not completely out. So there's still, there's still a lot of opportunity in this market. I think valuations change. I think expectations for public companies and IPO change, but it's not all gloom and doom. So, that's hopefully some things that folks took out of this segment. Any final closing questions or thoughts, Tyler and Josh, before we go to the next segment?
Real quick, We Hack Purple was Tanya Janka, a friend of mine. And so as part of the acquisition, all of the courses, I believe, are now free. So if anybody wants any of the We Hack Purple developer security AppSec courses, I think they're free on their website now. Just FYI. They got acquired by Bright.
Yep, that's awesome.
Oh, wow. That's pretty cool. No, this is very positive to see, honestly, with all of the people freaking out about the recession and it probably could get bad. I don't think we're going to see the same level of recession just based on where we're at coming out of pandemic and how well some of the stuff is still performing and how the market is still keeping up. It's really positive, and hopefully that brings a little bit of light to someone's day that it's not all doom and gloom.
Right. And with that, we're going to take a quick break and then cover the leadership and communications articles for this week.